Hi there everyone, good afternoon. This is Closing Trades right here on ET Now. I'm Avan Dabash, with me Aisha Faridi. Well, it is a flat market at hand, so we've paired off some of those earlier gains, currently quoting around the 17,033 mark in trade. No deep gashes, so nothing to really worry about, but it's a 100-point downtick on the Sensex. For now, the European markets as well have seen a little bit of a downward bias, so down 0.5% across the European screen. So we failed to hold on to those early gains, slipped off something like 170 points from the top of the trading session. Mind you, the broader end of the market is managing to hold out, so that outperformance is evident in trade as the small cap index quotes higher by about 1% or so. FMCG stocks across the board, as well as heavyweights like Reliance Industries, they're continuing to lead the fall. Add to that list names like Bharti Airtel, Britannia, Axis Bank, as well as the HDFC twins. Yes, indeed, it's the broader markets that are showing you traction. So for now, that's where all the action is. But Aisha, for the frontliners, flat as ever.
Yeah, it's flat as ever, and it's disappointing considering we've given up all of our morning gains. Although there is quite a bit of activity when it comes to the broader end of the markets. Ramakrishna Forgings as well as Sitagar Wagons have forged a wheel project win. They've emerged as the lowest bidder in a forged wheel project, and they've, beat the likes of a Bharat Forge, etc. as well. This KPIT Technologies too, a tie-up with Honda for software-led mobility. So that is another stock which is in focus, currently holding up by about almost 8% as we speak. And of course, IEX, this is pretty much a unanimous call from both of our chartists as well, who we will just revisit their views on. Axis Capital has upgraded the stock to a buy with the target price of 175. So this is another stock which is holding up quite well in trade. But yeah, besides that, the market breadth, one would have to say, is not looking all that bad, at least within the liquid universe. We've got a count of 110 standing to the advances with only 84 to the declines. So Adani Enterprises, GMR Infra, IEX, like I just mentioned, Adani Ports, Petronet LNG, these are all names which are actually holding out in the green as we speak right now. Good time as any to bring on board then our chartists and figure out what they're making of the trading day so far. Naresh, hi, afternoon. Couldn't quite hold on to the morning gains, but decent a day for the broader end of the market.
Correctly put, if we look at the broader market, it's almost a 3:1, say, advanced decline, which is really a strong indication on a day like this, wherein the bank Nifty has dropped off 500 points from the top. The Nifty has given up 150 points from the top. And yesterday's lows are still holding on. More importantly, a lot of stocks have come down to the major support areas, which need a much bigger trigger to fall. So, for example, Reliance is back to that 2200 to 2300 band. HDFC Bank is back to that 1530 to 1550 band, which is where we last saw a big gap up on. Same way, a lot of heavyweights, very similarly 500, 520 for SBI. So I would expect, say, the risk reward at these prices is good. I would expect a bounce back from here. At the same time, we are seeing stock-specific breakouts also. So we are seeing a lot of power names do well. The public sector enterprises holding on. So oil and gas also doing well. So time to be more stock-specific, but at these levels, even the index has started looking interesting finally.
Kunal, you ready?
Yeah, very much.
The charts are shaking. Not even one day the bulls are able to...
Not even one day of recovery, and I think that too with one of the best global handovers.
Exactly. So, I mean, just tells you that the problem is global and the nervousness is local.
Yes, yes. I think very well put, Nikunj, because, in the morning I was actually expecting that the Nifty would at least close with, say, 100 points plus about that 17,150 mark, and the Bank Nifty maybe around 300 odd points.
Europe's on the back foot as well right now.
But then,
but we didn't.
So we've not participated on the upside, but we are participating on the downside. That's a sign of weakness for a market.
Everybody is now tracking Fed. Everybody's become an expert on Fed, and everyone has a view on what Fed will do next week.
Banking
Exactly.
sector.
So we've stopped tracking RBI. We've stopped tracking what is the shape of the economy. By the way, India's inflation also came out yesterday.
Yeah, no one took cognizance of that.
US CPI.
Yes, CPI is what we are talking about.
Yeah, but actually Shankar Sharma was saying that, some of the problems that we are seeing, they are a little more domestic driven, though I don't know if that's really the case, given that we're clearly reacting to the nervousness that we saw across the globe. Yeah, so that's the status on the index, just about clinging on to the green as we speak at 17,050. Naresh, let's get in a take on those heavyweights within the FMCG basket, the likes of HUL, Nestle, they're all dragging their feet. What do you make of that?
So, the view has been negative for quite some time. The stock prices have been sideways instead of correcting. And now we are seeing breakdown. So the major one, which is HUL, has now broken a 6-month low. So the last low in November was closer to that 2400 mark, or closer to exactly 2430. We've broken below that also. So actually that augurs in terms of a trend change on the downside. So not very bullish on them. Same is the case with the Nestle, which is again making a 6-month low. So overall negative on the space, but would I be shorting? Difficult, because these are stocks which drift very slowly.
Okay, in fact, since we're talking about what the market mood is like, and clearly the current turmoil will not be as bad as the global financial crisis. That's the word coming in from most of our market experts. Shankar Sharma sees good opportunity in fixed income and, of course, select mid caps, while Sandeep Tandon is betting on value themes like metals, power, as well as PSUs.
My belief is you're not going to get a broad bull market. I don't think any of us should hold out hope that we are going to see a broad bull market in India, that is, anytime soon. We are going to see very patchy markets in which a reasonable part of the markets will be flat or even down, while small pockets of stocks, whether in the Nifty or below the Nifty, will be doing well. And that's really the skill of your investment acumen will be tested in this year.
Any such corrections, are seen or should be seen as an opportunity to invest. And in 6 months, whether it is 3 months, 6 months, nobody knows. But definitely these are very attractive points. India's story continues to remain. In fact, our interest rates are not in a dangerous territory. In fact, as inflation settles down, which I think is a matter of time, whether it is 3 months or 4 months, I think we have already seen the peak, and slowly you start seeing only coming down. There could be case made for Indian interest rates coming down. Whether it is again 6 months, 12 months, I don't know. But Indian economy is on a solid path. And slow down of 1 or 2 quarters always happens.
If I have to look at 2023 now, yes, it will be volatile, but if we can say with good amount of confidence, the top is in place. So answer is big no. Okay, because the characteristic from a behavior perspective, what we look at from a various conditions and euphoria which has happened across all the street has not happened. Okay, which means that if I have to look at larger perspective, you will see again all-time high as early as maybe in the last quarter of 2023 or maybe beginning of first half of 2024.
So Indian market is actually a wealth creating market. So you should not be perturbed by so much of this volatility, because that parts and parcel of equity investment. But if you are a long-term investor, definitely equity as an asset class will outperform bonds. And I feel that this is what one should look at. Secondly, India is in a sweet spot with respect to the GDP growth, with respect to the equity market, with respect to flows.
Okay, let's just understand the market construct a little bit better. And, just looking at of course, the Adani group of names which are bouncing back today. There's Asian Paints after that cool off that you saw in Brent of about almost 1%, and the fact that now Brent is sitting at $78 to a barrel. Besides that, Asian Paints, of course, is the one which is leading the charge, but Asian Paints has significantly underperformed also, not just the rest of the Nifty constituents, but even within the paint sector. Tata Steel is holding out well today. This Titan, L&T and Kotak Bank, which are actually contributing to today's Nifty mood. Pulling it lower, Reliance, that continues to underperform, 1% lower still. There's HDFC, which is down nearly 1%. HDFC Bank also, which is lower. Similar is the price action for an SBI, for a TCS as well, which has gone soft today. And IndusInd Bank is really having hugely volatile days, literally one up big day and one down day and one up day. That's been the pattern. And FMCG, of course, is on the sidelines as well. Both Nestle and Unilever are down about 2% as we speak right now. But why exactly is Reliance underperforming? It's fallen almost 6% in just the last 5 trading sessions and 13% year to date. Somit is here with perhaps some reasons why, Somit, could Reliance be lagging?
Well, the biggest concern among the investor community is the capex or the capital expenditure cycle of Reliance Industries that has been currently ongoing. Now there is lack of visibility and and clarity on how this capex is being done by the company, how much they are doing towards new businesses, what is the kind of return they are expecting. There is no clarity on this front, and that is one of the biggest concern that the investor community has when it comes to Reliance Industries. Other than this, because of this capital expenditure and various acquisitions that the company has been doing, if you see the company's net debt, it has been continuously increasing from being a net debt free company. The company now has a net debt of close to 1 lakh crore rupees, and given the high interest rate cycle, the company's interest cost is also expected to be higher, which is expected to eat onto its earnings per share going ahead. Along with this, there's a general consumption slowdown that we have been seeing, and the two consumer-facing businesses of Reliance Industries are expected to bear the brunt of this, and that is Telecom and the retail segment. Along with this, the petrochemical margins, now they are yet to recover despite the fact that China has reopened, and that was one of the biggest key trigger for Reliance Industries that has yet to play out in the industry, and the petrochemical margins are still languishing in the market. Along with this, the Singapore gross refining margins that help the refining business of Reliance Industries, they have also fallen. In January, we had seen an average of around $10 per barrel, which came down to around $7 per barrel, and right now they are trading around the $6 to $7 per barrel mark. So falling gross refining margin is yet another concern. And lastly, if you see the tariff hike, which was one of the key triggers for the telecom business, that is yet to play out in the industry, and the market perception is that till the election period is not over, there might not be a tariff hike coming in the telecom sector, which could lead to lower growth when it comes to the telecom business of Reliance Industries. And lastly, if you see the FY24 EPS is suggesting a growth of around 19% in the EPS of Reliance Industries, which might not play out because of these factors that we just spoke about, and hence there could be EPS cuts going forward, which is also a big concern for Reliance Industries. Now, if you see the SOTP calculation of Reliance Industries, it's the retail and the Jio business which hold more than 50% value, and both these businesses could face a slowdown going ahead. So these are the bigger concerns when it comes to Reliance Industries, and that is the main reason why it has been falling in trade for the past couple of sessions.
All right. Now, a statement coming from Coforge that revenue from US regional banking clients is very limited, and regarding their exposure to SVB, I mean, this name I think I must have uttered at least 100 times now from the morning. Exposure to US regional bank is very limited. Now, there is a panic which had kicked in the market that BFSI is the largest space for Indian IT companies, and if any bank goes under, could this have a 2008 kind of an impact where the outsourcing just simply vanishes? Intellect has said very low exposure. I think yesterday flashes from Coforge. LTTIS and LTTS also had an analyst call yesterday after the bell, where they've also come out and said that look, we've got a very limited exposure with the banks, which in a sense are getting into trouble. So that's an important explanation. But the market mood is so somber that when there are sellers largely because of technical pressures, nobody cares about it. HUL, by the way. And Kunal, this is interesting bit, right? I mean, HUL, Nestle, they're defensive names. And when defensives, they lead the decline. It just makes you wonder that is the sectoral rotation changing or are we missing on something? Because when markets go down, you buy IT. Markets go down, you buy HUL. When markets go down, you buy Nestle. These stocks are leading the decline.
But I think the last 2-3 months, this narrative has changed for defensives, because the three sectors which have actually, we call them defensives, out of them, the two important ones, the pharma and the FMCG, these stocks in the sectors, have actually gone through the first round of correction. So I think the FMCG index actually topped out at 2000, HUL topped out at 2,700 in the month of December, and the stock was already at 2,500 levels just about last week or so, and now it's showing signs of a bit of an aggressive sell-off. But then when you look at the trend over the last 2-3 months, these stocks had already participated in the first leg of downtrend for the indices. My sense is that most of these FMCG names, Nestle, Britannia, Dabur, HUL, these stocks have shown signs of fresh breakdown on the charts. Now, that's where I believe that there could be incremental sell-off. It could be some bit of profit booking on a more longer-term perspective for traders for investors who've been holding on to the stocks. I think for them, they could be looking out to just spare out some profits, trying to raise cash in their individual portfolios. I think that's the best way in which I could probably fathom that. That's one of the reasons why the FMCG stocks are getting sold into.
All right, that's the view coming in on some of those classic defensives from a technical standpoint. Time for a very quick break. Be right back as we continue our market talk when we return.
who joins us, KIO Equity with LIC Mutual Funds. Yogesh, good to have you on ET Now. Thank you for joining us. Let's understand that why Indian markets today are not reacting to global cues. And if the problem is global and the nervousness is local, why is that we have sell-off in names like HUL and Nestle, which have nothing to do with banks, which have nothing to do with leverage? They're cash-rich companies and they're going down.
Good afternoon, and thank you very much for hosting your ET Now. You're absolutely right. But is the characteristic of market basically. See, market continue to be remain volatile in short term, and you don't know in liquidity crisis there are also good companies also getting a sell-off. I can't directly correlate and I can't comment on individual stocks, but it seems to be some of the things maybe behave irrationally in short term due to liquidity crisis, and because so many negative events playing out together, like high inflation, rising interest rates, geopolitical tension, basically liquidity crisis. So it's very difficult to pinpoint what is the exact reason for which company. But at the same time, we need to see, we should not look on day-to-day basis, because if you see that every second day some companies up and every second day companies down actually. If you see the broader Nifty and stocks always remain in range bound from last few weeks. So it is very difficult to point out.
When do you think the tide will turn? Do you think it's all about Fed? And depending on the Fed communication, this market will move this way or that way?
I wish I could predict that move. But definitely, I already said, because a lot of negative events playing out together. But definitely, answering to your question, Indian markets actually is very much attractive right now. Because if you see the FY25 EPS is around 1050, now Nifty is trading at roughly 16.2 times. And valuations are actually much lower, what we seen 2 years back. At a peak of last 2 years, valuations came down from 29 times to 16.2 times. So definitely higher interest rate, higher inflation, and some of the negative news like what we heard about SVB banks and geopolitical tension like Russia-Ukraine war. So there will be events playing around Nifty and market. At the same time, these events also have some time period and overall basically cycles. So as and when we see a clarity on interest rates, more and more clarity on business front, so definitely flows will come, and whenever flows will come, it's followed by market movement on upside actually.
Yogesh, your outlook on the auto sector, given the fact that, a lot of experts as well as the corporate voices have been indicating that issues when it comes to semiconductors, supply chain, etc. have now eased and are behind. Where is it that you're tilting towards within auto?
Yeah, we are also positive on basically auto sector. But see, there will be some models facing semiconductor issues. But considering the waiting period and on new models, we are quite optimistic on selected auto companies. And at the same time, it gives the opportunity to play out because auto sector has not performed in last 5-6 years. So we are positive, and we, as of now, we are not hearing any negative from like semiconductor, except few models in some of the companies.
Let's talk about a sector which you are part of, the insurance sector. What do you make of the growth in the life insurance space, the entire thing which came from, I'm just purely talking about the sector, it's not LIC. But since you are associated with LIC, I'm sure understanding of the life insurance sector would be very deep. So what's happening in the life insurance sector, given that there are policy changes, the sector has still not recovered from the COVID lows?
Definitely. See, we are LIC mutual fund. Definitely, I'll answer your question. But as other sectors, due to higher interest rates, insurance sector also seen a slowdown slightly, and because of budget, the optimism is also lower. That I can only say. At the same time, we need to see the long-term story in insurance sector because of the considering the penetration and the population still headroom to grow is very high from here. But in short term, we might see some depressed growth, maybe for 2 to 3 quarters.
Us markets, what do we have? No recovery. Just going to refresh my screen. Is it no recovery or yeah, no recovery? And what do we have? Metals which are holding on. Nuresh, if there is a problem in global markets, if everybody is worried about inflation coming down or recession coming around the corner, then metal should be the first one to come down. Crude is down, but metal stocks are holding on.
So we are seeing a lot of, say, logical things which we look at not working on because it's been a valuation mismatch across the board. Stocks have fallen a lot, metal stocks have fallen a lot. Same case if we look at the way we were discussing FMCG, these are expensive stocks, so they are no more defensive. So anything which has been expensive has been hit much more. Same way, metals are not expensive, so they are not taking a crack anymore. They were expensive a year back when there was a lot of craziness. So what we are seeing right now is the markets are much more towards value. Anything which is more expensive and has done really well is taking a deeper crack. So metals is something which I would be selective because again, you have a Jindal Steel which is closer to an all-time high, and you have a Tata Steel which is 30-40% away from an all-time high. So the choices has to be stock specific. So I still like Jindal Steel in the metal pack, which looks interesting.
Let's get in some closing ideas as well. Going on that note, Nuresh, on your list?
So again, the same sectors which I've been looking at, oil and gas and power, and that is where I'll stick with IEX. That is a stock which has been continuing with that momentum from 140 today, also made a new swing high. Expecting this to continue.
Now, what about your closing ideas?
So that'll be a buy on IEX. We discussed this in the morning as well. The only good part about the charts today is that the stock breaking past about the 200 DMA after almost 1.5 years of trading below this average. So this could possibly be a sign of turnaround for IEX.
There were 2 back calls on IEX. Kunal, consensus does not work.
It has.
No, but in this case.
Over the last many months, things have changed.
Okay, my next question is that when the market itself is looking down, why should one buy at all? Forget IEX or forget NTPC, you'll always find individual pockets of strength. Why not identify a name which is looking weak as a STBT idea rather than a BTST idea?
No, I think there are a few sell calls also which are there. So, of course, having a balanced approach is a much better approach in this kind of a market. That's absolutely, that's undoubtedly right, Nikunj. But then I think, you also have to spot on those charts which are showing signs of relative strength. And I'll probably refer to IEX back again because I think in the last 1 year, this was a stock which was beaten down significantly. So, at a point when the Nifty was sideways, then moved up higher, IEX managed to underperform. So, a stock which moves up and down, aloof of the market scenarios and trends, I think that's where the charts of IEX stand out.
IEX, MCX, that also I think is pretty much close to its 52-week highs, that of 1697 thereabouts, and the stock currently is at 1500 thereabouts. That also doing well. So yes, sure enough, some bright spots within this market as well. On that note, we're going to take a very quick break, come right back, continue to track markets on the other side.
What do we have? We've got a Nifty which has slipped from the day's high. The mid and the small cap stocks are holding on, and that I think is I won't use the word funny, but that's the real strange part, because when you got HUL and Reliance going down on the same side of the trade, these are typical FI, ETF dominated stock. That means there is a nervousness in the market. Open interest is low. DI investors are running out of cash. HNI investors are almost on the sidelines. Yet mid and small cap stocks are holding on. Like, look at the group of stocks which are outperforming and underperforming. Adani again. So Adani Power is up. GMR is up. IDFC Bank is up. And you've got IEX along with JP Power. So a lot of penny stocks are moving higher today. In terms of value and in terms of transaction, Adani Enterprises, Adani Power, Adani Ports, L&T, Bharti is down, but Asian Paints is moving higher. Kunal, net Adani group of stocks are outperforming now. And again, this is like the high beta space where you know that institutional buyers are not there. Retail guys have burned their hands actually. And you've got HNI investors and DIs who are not active. Yet these stocks are outperforming.
So this tells you, Nikunj, that this is not a capitulation selling in the markets, because when you're into a capitulation selling or when you're into a final leg of selling where you don't look at the price, the price as well as the name of the stock, but you just want to exit so that you want to pare down the risk of your portfolios. That's a point of time where we see all the stocks, whether good stocks, bad stocks, large caps, mid caps, all of them they tend to correct very sharply. Today, I think again, in the last couple of days, we've seen that there's this exception in the markets where stocks which have been earlier underperformers and there have been good change of maybe fundamentals, etc. These are the stocks which have been bought into. Stocks where, for example, the Adani group of names where there's been already a lot of hammering into these stocks from their January highs, and now when the open interest is significantly low as compared to the ones which were seen 2-3 months back, that's where these pockets have started to outperform. So I'm not saying that these stocks would continue to outperform, but it's just that the selling interest is not as strong into these names. And the only reason which I can attribute is because there is no major capitulation which is happening in the markets right now.
Sudeep Bandyopadhyay, the problem is global. A bank has gone belly up in US, and the stock which is falling here is SBI and HDFC Bank. There is no correlation, but yet the selling is intense.
Hi Nikunj. Yes, one bank has belly up and a couple of other banks are also tottering. So there is a significant question mark over a lot of mid-sized banks in US. Of course, there were a different lenient set of regulations there, and now they're talking about bringing in Basel III for mid-tier banks as well. But that's for the future. As things stand today, there is significant concern about the health of a lot of these mid-sized banks in the US, and that's keeping the global investors on tenterhooks. They are nervous. They are nervous about the banks. They are nervous about the IT companies which service these banks. They are nervous about a lot of companies which have dealings with these banks, including deposits. Though the government has done a good job by protecting the deposits, still there is significant write-off which investors and bondholders are taking as far as these banks are concerned. So the atmosphere in US and the global markets is of concern, is of panic, and that is getting reflected in India. And I think you were just commenting that FIIs, global institutions, have been selling, and that's very clearly visible when you see an HUL and Reliance coming down sharply, and some of the small stocks are not reacting that negatively. So obviously the selling is predominantly being driven by global investors, and of course HNIs are sitting on the sidelines, waiting and watching. DIIs, probably they are also sitting on the sidelines, and the liquidity for them also is kind of not significant at this stage. So all this put together, I think a bit of a concern in the market. As far as the domestic market future is concerned, the predictions around El Nino are nothing to cheer the market. We already had a challenge with rural demand for some time. We were expecting that rural demand will start picking up, things will start looking up, and now we have this El Nino related concerns, which definitely doesn't augur well for Indian capital markets, Indian economy in the near future.
Sudeep, hi there, good afternoon. Wanted to also understand and get in your take on what you make of some of the defensives as well, taking a bit of a hit in today's trading session. Some of the classic FMCG heavyweights like Nestle, Britannia, etc., feeling the heat. What is this indicating?
Well, a couple of things. One, as I said, the global investors are selling. So, when they sell, they will sell the stocks which they have. So, some of these stocks, FII had significant holdings, so they are exiting. The second, I just mentioned the concern around, Indian rural demand, Indian consumption demand on the back of, the El Nino, which is being forecast, which will obviously, assuming the forecast is to an extent accurate, will lead to significant challenges on agriculture and consequently rural demand and the related stuff. Look, 60% of Indian population still depend one way or the other on agriculture and agriculture-related sectors. So if you have a challenge there, obviously some of these companies which have a huge market in rural and semi-urban India will suffer. So that's probably getting reflected.
Tata Motors down 5 rupees, fall is 3%, and it's all about that global mean reversion which has started. Bharti, the war has started again. Jio has come out with a new third attempt to regain the postpaid market. You know, the postpaid customers are very sticky, and that's where Bharti has an edge. They're coming up with another. They've announced a new scheme. That's the new scheme there for you. Plan 299, no additional schemes, but I think it's really the unlimited data at 599, which is the new one, which just means that the telecom war clearly is not over yet. It's not a free fall for Bharti, but it is certainly going to be having an impact on the sentiment per se. Kunal, one stock which has done rather well for itself in a falling market, I think, is IDFC Bank. Today it's up, otherwise it's outperformed. Is it looking strong? Can it go to 65, 70, its previous levels of previous highs?
Well, not immediately, but yeah, I think there is an inherent resilience for the stock. So, the best way to measure the resilience is the correction from the recent swing highs for these stocks in the last 2-3 months, as compared to the levels of the stocks above the 200-day moving average. For example, when your benchmark index, that's the Bank Nifty, when it's trading below the 200 DMA, we tend to scan that which are the stocks which are trading above their 200-day moving average, and then these stocks have corrected by less than 10% from their previous swing highs. So I think in that regards, maybe even HDFC Bank, I think, is showing some bit of resilience still as of now, trading above the 200-day moving average. But then that could not be a benchmark that these stocks may come back first and move up higher. So, it's possible that, these stocks may see the selling at the last leg of the market correction, where you might probably see more, 8 to 10% correction into these stocks. That could be a better level to buy. So I would not hurry into buying these names, but yes, there is an inherent strength into these stocks, and that's been one of the reasons why these stocks are not falling as hard as compared to the other high beta private sector names.
So, Sudeep, we were just analyzing Reliance's underperformance. The fact that it's down 6% in the last 5 days and 13% year to date. What explains this?
Well, I think explanation is FIIs are selling, and FIIs hold Reliance, and when they sell, they will of course sell the stocks where they are still in profit. So I think Reliance is also being sold by FIIs. The second is the challenges around the ARPU as far as the telecom business is concerned. The market and the analysts were expecting the ARPU going up for quite some time, but contrary to that, I think we are seeing with the new schemes getting launched, the telecom war again starting as far as customer acquisition with Bharti, the ARPUs are again under pressure. Now that doesn't augur well for the profitability of Reliance. So I think these are the two factors I can see straight away which are contributing to Reliance coming down. I would probably hazard a guess here that this fall will kind of get stopped as soon as we see a turnaround in the market and change in sentiment. Fundamentally, for a medium to long-term investor, as far as Reliance is concerned, nothing much has changed. It has still significant value unlocking opportunities going forward when Jio gets listed or a retail gets listed or some other restructuring happens through of the green business, green part of the business, green energy part of the business.
Today, frankly, the small and the mid-cap space has outperformed. But is it a matter of, let's say, maybe a day, maybe a couple of trading sessions, it has to follow the Nifty?
So see, the fact is, it's very odd today to see the small cap up. But the reality is, if we look even at the Nifty today, it's only the heavyweights which are taking the major knock. For example, a stock like HDFC Bank is down 1.4%. Reliance is at a 52-week low. So it's more the heavyweights which are actually seeing more pressure even in the large cap Nifty space. So the breadth is still, even after the fall today, the breadth is even. So it just tells you the fact that there is a lot of pressure, FII selling more on the heavyweights rather than the whole market. So I would not expect a sharper correction in small caps.
Meantime, Sudeep, wanted to get in your thoughts on some of these retail plays, the likes of Vedant, Fashions, Page, Trent, etc. Recent reports seem to indicate that rising competition could be a little bit of a concern for some of these companies, but won't eat into the numbers or in the profits of the companies. Your take?
Well, as far as you mentioned three, I think I like Trent out of that. I think the Zote part of it, the Zudio part of it is expanding, and I think it's targeting a different niche. Also, as far as overall trend is concerned, the private label business is picking up. They're also focusing on the high margin part of the private label, which is the leather products, the accessories. I think these should take the profitability of trend to a different level. The expansion also is happening as per the plan. So we are positive on trend, and we believe that leave aside these short-term market movements. If somebody is looking at a 1 year kind of a time horizon, trend is a good buy. As far as Page and Vedant Fashions are concerned, both are good corporate companies, managed well in the right segment, but the valuation looks a little too full at this stage. So I don't think I will recommend investors to buy at this stage.
Sudeep, in general, how do you see these expensive PE stocks moving? When you got so much of price adjustment in the world, interest rates are moving higher. Do you think these expensive PE stocks are unlikely to outperform?
For some time, definitely, but I would like to focus sector-wise, Nikunj. Let's look at FMCG now. If the El Nino fear turns out to be, not real, and we have a good monsoon, rural demand starts picking up, I think we will all forget about the P multiples which Nestle or HUL today is attracting. And we have seen this story getting played time and again. And I think we will revert back to the growth and other things. Forget the P. These are evergreen stocks. Look at Asian Paints. Look at let's say Page Industries. Story is pretty much the same. They are the leaders in their space. India is a huge market which is growing in a big way. So yeah, once things settle down, they will continue to attract significant multiples, which will be looking at on a standalone basis look absurd or look very high, but they will attract high Ps, and we have to accept that. Yes, as far as short term is concerned, all this concern around the high PE will be there when overall the market sentiments are down, and we will see large institutions exiting some of these stocks. But they will come back as soon as things turn around. They will again come back to HUL and Page and Nestle's of the world.
Sudeep, so currently in this market, what are you advising long-term investors to do? Wait till the dust settles down, sit on the sidelines, or are you already finding lucrative opportunities to get into?
Well, I think you have to be a little careful in this market because we are seeing continuously value erosion. I remember 2008. I think everybody is talking about that. But between the time the problem started and some manifestation was there, people have started talking, and when it blew up, there was 8-9 months gap. So what we are seeing in US banks, we'll have to be a little careful. It's very easy to say this is not 2008, this is different, these can be contained, the US government is taking action. Of course, US government is taking action. But what is the full ramification of this? I don't yet with certainty can predict. So I will be careful, and I have been advising investors to be careful too. Yes, there are opportunities in pockets. Particularly, I like the infrastructure construction sector in India on the back of the public expenditure which the government has categorically outlined in the budget. So Larsen & Toubro, let's take an example, I think is an excellent buy at current levels. Somebody having 1+ year time horizon. Similarly, there can be multiple other opportunities in construction and infrastructure space, but it's better to wait and watch rather than rushing into the market at this stage.
Time, Naresh, let's get in a check on the charts. Asian Paints as well as Page Industries.
So Asian Paints has been in a downtrend for quite some time. A little bit of a bounce back today on the back of crude, but I would still be a little skeptical here on this bounce. Till the time it doesn't cross 2900, it still remains a stock which could be sideways to down. Page Industries, again, another stock which has been in a one-way downtrend for almost the last 4 months, down from 54,000 all the way to 36,000 levels. So still just a one-day bounce here, so not very positive as well here.
Sudeep, some very positive commentary coming in from PVR's investor call, the first one after its merger with Inox, saying that 12 to 14 months they're going to be realizing the merger synergies. The annual EBITDA synergies stand at about 200 to 500 or 250 odd crore rupees. They're talking about as to how F&B is going to be, of course, a key contributor to the revenues, and that they're at a very, very aggressive pace. We've already seen that, of late they've had many screen launches, in states, in places like a Lucknow, in a Chennai, etc. as well. At these current levels, even though PVR has lifted quite a fair bit of late, at 1545 thereabouts, does it make for a good buy?
Well, two things, Aisha, I will say. One is merger is definitely a good deal. I think it does help the combined companies significantly to negotiate better and get better realization on pretty much all areas, whether it's in advertising, whether it's F&B, whether it's the negotiation with distributors. I think they will have a much better position, and I'm expecting this will be a margin accretive merger. That's point number one. Point number two, I think we have seen in the recent past the movies have started attracting higher footfalls, and that's a very good news after a long time as far as PVR Inox is concerned. Third thing which I like is that they have also in today's call and earlier also talked about delivering food. I think this was one area which they haven't focused, because they have a good F&B counters in the auditoriums, and that food was not available outside. So only if you're going for the movie you can get that food. Now probably there was no reason to hold that back. Now with the delivery starting, people can access that food. That opens a kind of a window for them to access a larger part of the market on a continuous basis. So some of these good things should help PVR. As far as acquiring the stock at this level is concerned, I think if you're a long-term investor, let's say 1 year plus time horizon, I think it's a good bet. It's a bit of an aggressive bet considering the valuation, but no harm in taking an aggressive bet in this sector, because entertainment, we believe, is an evergreen sector.
Meantime, Kunal, what's standing out within the metal space today?
Well, I think only SAIL is the one which I believe looks strong, because I think out of the other stocks, when you do a relative strength analysis, the likes of Hindalco, Vedanta, in JSW Steel, Jindal Steel, these stocks have actually corrected by somewhere around 10% in the last 1.5 odd month. And in that same time span, SAIL from I think 82 levels or 82.5 levels has actually climbed back about 88 levels. So not just on the negative side that the stock has not participated on the downside, but it's actually given some positive price performance. And I believe that's one of the standout features for the stock, at least over the last 1 odd month. So if I have to bet on the metals pack, I would look out for relative strength names, and I think SAIL stands out to be one. Even Tata Steel relatively has not participated on the downside, and I think that's a very strong change of behavior for the stock, because I remember over the last 1.5 odd year, Tata Steel has been a huge underperformer as compared to the large caps and mid cap metal stocks. But then I think in this wave, Tata Steel has not fallen very sharply, and the stock is somehow settling at this 108, 9, 10 kind of range for itself. So I believe that could also be a point where we may look out for confirmations of breakout and look to buy Tata Steel as well.
By the way, the Nifty Bank index as well has cracked in trade, now quoting around the 39,000 mark. Kunal, what is the importance of this? It briefly cracked below that level, right?
Yeah, I think we've managed to break below 39,000 mark, but more importantly, we've managed to break below yesterday's low. So that I think is a bigger point of concern, because if in a pullback or in an attempt towards any kind of recovery, generally 1 day low or 2 day lows, they generally get protected. But this is the kind of market where even on such a kind of a strong global Q, we've not been able to protect yesterday's low, both on the Nifty as well as on the Bank Nifty. So that's a clear indication that it's a sell on rise kind of a market even as of now.
Yeah, and the Nifty as well at the low point of the day, sub the 17K mark once again, which we've breached twice in this week itself, and we're just about midweek, right? 17,968 is where we're currently at on the index. Let's get some closing ideas then going. Naresh, what would you recommend?
So that would be again a buy on the power space, a buy on power grid, just 2 points away from a recent swing high. 5 points away from an all-time high, expecting that to be touched. A stop loss at 227 and a target price of 236. Second is a buy on IEX, the largest volume in last 6 months. A stop loss at 149.50 and a target price of 162.
There you have it. That's what Naresh is recommending. BTST trades then from you, Kunal.
So I'll go with one buy and one sell. The first one is a sell on Jubilant Food, showing signs of a fresh breakdown on the charts. Targets of 418, stop loss at 439. And the second will be a buy on Glenmark Pharma. It makes a lot of sense to now look out for pharma names which are showing signs of strength. So Glenmark and Zydus Life are the two names which are actually showing signs of strength. So I'm picking up Glenmark as of now. Targets of 442, stop loss at 418.
Okay, there you have it. Those are some of the stocks that our chartists are flagging off. But just keep an eye out on the markets, because now that clear nervousness has seeped in, the broader markets aren't managing to hold on to their gains. PSU banks, the Nifty Bank, as we highlighted, slipped below 39K, briefly on the brink of that mark right now. It's auto, FMCG, IT not being spared, although it's a cut of just about 0.2%. Mind you, despite what's going on, the metal sector is holding out quite well, and pharma to a certain extent, Kunal just alluded to picking out some of the stronger pharma names. Take you through some of the big drags on the frontline index. Bharti Airtel at 756, IndusInd Bank down close to 2%, weakness in Reliance Industries very pertinent, SBI, HDFC Bank, HDFC, Axis Bank, ICICI Bank, all weighing down heavy on the Nifty Bank index. You've got something like Wipro as well as Bajaj Auto and Tata Consumer. Those are some of the other stocks within the large cap space that are looking rather choppy. Within the broader markets as well, just identifying some losers. There's names like Spark, Mahindra CIE that are cracking in trade. TV18 Broadcast is seeing a cut. Astral, along with Prism Cement, SpiceJet, JK Lakshmi Cement. Those are some of the other weak links in trade. So, Kunal, just to sort of reiterate, what is this indicative of now? The fact that we're sub 17K with quite a bit of conviction, 16,966. So what is this indicating for the next few days of trade?
So it indicates more weakness, and I think
in terms of levels,
in terms of the market strength, and for these kind of markets, for someone who's expecting that the markets would get into recovery, a day like yesterday when the Dow, when the European markets, when most of the Asian markets hand over in the morning, they were extremely positive. We could not even sustain those gains of 400 points up on the Bank Nifty and some 100 plus points on the Nifty, and we've given away those gains quite easily, which means that the market is very fragile. Maybe it's a risk off which is happening, where traders are looking to just pare down their portfolios and bringing down risk significantly and using any kind of a bounce which materializes as a good opportunity to try and exit, or maybe bring down the portfolio sizes quite dramatically. So I think that's the only adjustment which is actually happening into the indices. The major level now for support, because 17,200 has been broken, the next major support for the index is at 16,500 mark. So let's hope we don't break those levels, 16,500 in a jiffy. But the market structure looks fragile below that 17,200 levels.
Sudeep, within the mid-cap end of the market, which is clearly underperforming and lagging even the broader, even the large caps, as always the case is, any opportunity that you spot?
Well, I think sector we have been eyeing is the sugar, and there's a structural change with the ethanol blending limits getting up and all that. But considering that it had run up recently, we are looking at a surrogate to that, which is Praj Industries. I think it's one of a kind company. I think very well established both India as well as global on the ethanol blending part of the industry, and with the focus on more and more green energy, I think their business will continue to grow both in India and internationally. Of course, they are into other segments as well, including wastewater management and things like that, which should do well. Strong balance sheet, I think significant opportunity for growth both globally as well as in India. So I think one can look at Praj Industries at current level. Of course, 1 year time horizon is what one should keep in mind if you're buying now.
Praj Industries it is. Meantime, Kunal, let's also get in a take on the charts of a Jubilant Food as well as IndusInd Bank, your favorite.
So yeah, Jubilant Food is something which I recommended on the sell side. I think the stock has given a fresh signs of breakdown below the 438 mark on the spot level. So I would expect the correction towards at least 420, 418 for Jubilant Food. And traders who I think who are looking out for shorting the stock, I think can keep just a 2%, 2.5% stop loss for this trade. IndusInd Bank could be tricky because I think that stock has again shown signs of weakness, breaking below the 1150 mark initially and then 1050 levels, the two crucial supports for IndusInd Bank. So I think there could be a higher probability that the stock may drag lower from current zones, maybe a fall below the 1000 mark as well and closer to 970.
Okay. Naresh, Kunal flagged off a Glenmark on the chart saying that, you should look at some of the high quality or outperforming the pharmaceutical names. Is there anything that you're spotting on the charts?
So not liking the whole pharma space. None of them have actually been able to sustain the pullbacks, and also the stronger ones like Cipla and Sun Pharma have also broken down. So the only space, like I've been saying, is the public sector enterprises, which I find good. Oil and gas and power. Rest of the names are still not showing any reasons for a reversal as of now, but would focus on these three sectors.
PSU banks, the Nifty Bank index, real estate, all to blame as we're struggling sub the 17K mark with conviction. It's down 0.5% for the Sensex, 300 points shaved off, and mind you, the broader markets as well have succumbed to selling pressure. Metals, pharma, your only spots of green. Big losers then, so take a look in IndusInd Bank, Bharti, Reliance Industries, Axis, HDFC Bank, ICICI Bank, Maruti, TCS, Tata Consumer, all falling flat on their face, while Adani Enterprises, Ports, along with Asian Paints, Tata Steel and L&T, they managed to buck the general trend. A few newsmakers then, and you have that weakness evident in Reliance Industries. Something like a Voltas management is seeing high single digits for the RAC business. Titakar Wagons and Ramakrishna Forgings have seen a railway supply bid, on the back of which those stocks are a buzz in trade. KPIT Tech has seen a software-defined mobility. It's got a partnership with Honda on the back of that. You've got NBCC, which has got some work orders from Puducherry, close to 500 crore rupees. Meantime, those are pretty much some of the newsmakers. BHEL, Paras Defense has entered an MOU with a company in Israel, and Railtel has received an infra order worth about 200 odd crore rupees. Morgan Stanley has got his report on Vedant Fashion, Page, as well as Trent and ABFRL, so some of those stocks did manage to stand out. Nonetheless, within the broader universe, lots of casualties: Future Consumer, Spark, Mahindra CIE, Phoenix Mills, Astral, JK Lakshmi Cement, all cracked in trade. All right, on that note then, we'll wind it down on this edition of Closing Trades. Thanks so much for tuning in.